I'm sending Congress a supplemental budget request. It's going to keep weapons and ammunition flowing without interruption.
$33 billion will feed the war for a very long time. Long enough for Ukraine to be utterly destroyed, for more Ukrainians to be killed and displaced. Long enough that the world as we know it will never be the same again. In sports, this will be called an own goal. Who are the real winners and losers of this war? What does the remaking of globalization really mean for you and me? Hi, I'm David Wu, a former Wall Street strategist with a 20-year track record of making actionable predictions about big global events. Welcome to part one of Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we start, I invite you to subscribe to my free YouTube channel so that you will get notified when a new video comes out. Today, I will talk about the changes to globalization as the result of the massive and unprecedented economic sanctions imposed on Russia by the West. The currency market, the biggest market in the world, is like a giant mirror reflecting everything that's going on in the world economy. What do we see in it right now? Interesting enough, the Russian ruble, that was supposed to be rubble by now, remember? Has actually strengthened 14% against the US dollar since the start of the war, making it the strongest currency in the world during this period. The ruble is so strong that last week Russia cut interest rates by 300 basis points to 14%. This doesn't mean that the Russian economy isn't negatively affected by the sanctions, of course. The latest Russian data suggests that economic output rose only 1.6% in March from a year ago, down from 4.3% in February and 5.8% in January. However, the strong ruble does mean that the sanctions' economic impact is not as devastating as the US and Europe had hoped and expected. Certainly, the fact that the ruble is strong means Russia won't be descending into an inflationary spiral that could sap political support for Putin or spark a coup against him. Why are the sanctions having so little impact on the ruble? The answer lies in the nature of Russia's economy. Russia is a net exporter and was running a massive trade surplus just before the invasion. Russia imports primarily manufactured goods from the rest of the world, whereas the rest of the world imports primarily commodities, especially oil and gas, from Russia. This means it should be easier for Russia to find substitutes for its imports than for the world to find substitutes for its imports from Russia. Since such is the case, the sanctions will only have a limited impact on Russia's trade surplus, at least in the short term. Russia was also a major net exporter of capital before the invasion, meaning Russians were accumulating more foreign assets than foreigners were accumulating Russian assets. Think about it this way. More Russians were buying properties in London than British people were buying properties in Moscow. Western sanctions, by forcing Russian money to stay at home, have dramatically reduced the demand by Russian investors for foreign currencies, whether it's the US dollar, the euro, or for that matter, the British pound. The fact that Russia still runs a sizable trade surplus and that Russian money has no place to go is why the ruble is so strong. On Friday, Germany said it is ready to stop importing Russian oil. This could pave the way for an EU-wide oil embargo against Russia. But whether such an embargo will deal a major blow to the Russian economy depends crucially on the decision of one country, India. Let's just look at the numbers. Russia is the world's largest oil exporter. In December 2021, it was exporting 7.8 million barrels of oil every single day. The European Union, Russia's largest oil customer, accounted for 45% of Russian oil export in 2021. This means that if the EU were to stop buying oil from Russia, Moscow will have to find new customers to pick up the slack if it wants to maintain the current oil output. Which countries are big enough to buy 3.5 million barrels of oil every single day? Well, China accounts for 22% of Russia's oil export in 2021. If China were to double its import of Russian oil, this will mean an additional 1.7 million barrels per day in bringing oil import from Russia to about a third of China's total oil import. India is the fourth largest oil importer in the world and has room to increase Russian oil import. Indeed, in the 2 months since Russia invaded Ukraine, India has bought more than twice as much crude oil from Russia as it did in all of 2021. This is not too surprising, given India has not joined in with the Western sanctions against Russia, and given Russian oil is trading at a 30% discount of the international market rate. Boris Johnson's mission to New Delhi last week to convince Narendra Modi to take a tougher stance against Moscow went so poorly that the press conference following their meeting, any mention of Ukraine was carefully avoided. But the issue of India goes beyond India's interest in acquiring her oil needs at a discount. India and Russia have a long-standing relationship that goes back for decades. Russia is India's largest weapons supplier, the most important supporter of her policies in Kashmir, and a strategic partner in wide-ranging areas from civil aviation to nuclear power. A recent Ipsos poll shows that the majority of Indians are of the opinion that the problem of Ukraine are none of our business and we should not interfere. And what about what Russia was importing from the West? Russia imported about $122 billion of goods and services from the West in 2021. This sizable market is now up for grabs. China and India are well positioned to each take a lion's share of the market. The reality is that sanctions against Russia have created huge economic opportunities for both of these two countries. They will be able to export more to Russia and at the same time import Russian oil at heavily discounted prices. India, that runs a current account deficit, can also count on cheaper financing from Russia going forward, as Russia will need a current account deficit country to park its trade surplus. What is there not to like for these two countries that account for a third of the world's population? Not much. The US will threaten them with sanctions for helping Russia, but the US cannot afford to lose India in its new alliance against China. India, the country that gave the world the non-alignment movement, is in a strong position to make the most for herself out of the new political realignment in the world. It is difficult not to be bullish India. If India will be a big winner, who will be the biggest loser? Very simple. Europe. Not only will Europe lose Russia as a major export market, it will have to pay far more for its energy needs and will be forced to spend more on defense. Europe has been the perennial underperformer of the world economy. This triple whammy will further reduce Europe's structural growth potential. Europe's decision to blindly hitch onto America's total war against Russia will not have a happy ending. The market understands as much, and this is why the euro has been the worst performing major currency in the world since the Russian invasion. However, there's one wild card out there. Marine Le Pen lost the French presidential election, but the French parliamentary election next month will provide another opportunity for those against the total war against Russia to force a change in French policy. Le Pen wants to pull France out of NATO's integrated command. Jean-Luc Mélenchon thinks it's NATO's fault for the war in Ukraine. And Eric Zemmour wants the Ukrainian refugees to stay in Poland. In the first round of the French presidential election, they together won more than 50% of total votes cast. One of them might just become the next prime minister of France. This could either result in a complete political paralysis in France or help bring sanity back to the European calculus vis-a-vis the war. Regardless of the outcome, the recent euro decline is not over. Europe won't be the only loser. Another loser will be, of course, Australia. China is Australia's largest export market. Indeed, Australia exports more to China than it does to all the countries currently waging the economic war against Russia combined, meaning the US, EU, Canada, Japan, South Korea, and Singapore. Australia's biggest exports to China are iron ore, oil, and coal. It so happens that Russia is the largest iron ore producer in Europe. In 2020, Russian iron ore export to China via the Trans-Baikal Railway reached $1 billion. Completion of the Sino-Russian Tongjiang-Nenizh-Lenenskoye railway bridge has shortened the haul distance to a major Chinese steelmaker by 80%. Russian iron ore export to China is set to take off even without the sanctions. It is a reality that Australia's share of the Chinese iron ore market will suffer at a time that Australia's dependence on iron ore has gone up. Australia will have to ship more iron ore to Europe, but the transportation costs, of course, will be higher. The decision by the EU to ban Russian coal likely also means that ultimately China will be importing more Russian coal at the expense of imports from Australia. What about the US? Until recently, everybody understood that Washington's objective was the withdrawal of Russian forces from Ukraine. But the goal has broadened when Lloyd Austin, the US Defense Secretary, declared last week, we want to see Russia weaken to the degree they cannot do that kind of things that is done in invading Ukraine. This kind of talk is very scary, as it suggests the US is going all in. Unlike Europe and Japan, the US is rich in natural resources and is much less dependent on imports. Its trade with Russia is tiny. All these give the illusion of relative immunity from the war. This is also why the dollar is the best performing currency in the world after the Russian ruble. However, it is almost certain that the remaking of globalization will not be kind to the US or to the US dollar. The most striking feature of last week's release of the first quarter US GDP data is the fact that imports surged even as domestic demand cooled. This and the fact that inflation is at a 30-year high means the US economy is overheating. The economic sanctions imposed on Russia are exacerbating America's inflation picture and will force the Fed to raise interest rates faster than it would have been the case otherwise. As I've said in a previous video, I expect the US to go into a recession before Thanksgiving. The fact that Q1 GDP growth was negative gives me even more confidence in my forecast. With a record trade deficit of over $1 trillion, a recession is almost certainly going to be highly destabilizing for the US dollar and the world financial market. The US midterm election is only 6 months away. The polls are painting an ugly outcome for the Democrats. John F. Kennedy picked up 5 seats in the Senate in the midterm election after the resolution of the 1962 Cuban Missile Crisis. Is it possible that Biden is hoping a rally around the flag effect from his economic war against Russia will save the day? All I can say is that I don't want to find out. If you got something out of this program, please hit like and subscribe to my free YouTube channel. If you want to learn more, we'll watch the second half of this video in which I discuss my investment strategy based on this macro theme and others. Please come visit us at davidwuunbound.com. Thank you for listening.